S.Naren, he's Chief Investment Officer with ICICI Prudential AMC. Naren, good morning. Thank you for joining us. Naren, the environment is slightly challenging. Nothing has changed when it comes to the macro setup, but markets are holding on.
Yeah, actually that's the most surprising thing, because the last Tuesday's Reserve Bank action actually resulted in all the fixed income markets falling off, whereas the equity markets have seen in fact complete stability, and in fact last week the markets went up. So this has been a source of surprise to us as well, but as you know, domestic positioning over the last 6 years, people have absolutely gone underweight equities domestically. And so what happens is there is virtually no speculative position in the equity markets. And I guess that that has helped the markets significantly, although if they follow up on the monetary policy action by increasing short-term action, I don't think it's really positive for equities in the near term.
Naren, we've discussed this one in the past, that why markets are extremely polarized, and a polarized market is not a healthy market. But the bottom line here is that those who are buying pharma and FMCG stocks are making money, those who are buying metals and PSU banks are not making money.
Yeah, that's been a trend now for 1 year. I mean, what we've seen from our past experiences, that doesn't work that way, as you know from the experience of both 2000 and 2007. But the fact is that you have this kind of situation whereby, you know, we used to think consumer stocks were trading costly at 32 PE. Now they moved to 40 trailing PE. And still those are the stocks which are going up. So it's the kind of situation that the market is in at this point of time. I don't think it's a very healthy market, because if you're not going to see that kind of rotation, I don't think it's very positive.
Naren, what's happening with the banking pack? I mean, sure enough, there have been some earnings from some of the key participants wherein, you know, the top and the bottom line has been in line, but it's the asset quality concern which clearly seems to be weighing heavy on some of these names. Do you think that is a concern that we'll have to live with for some more quarters?
See, we've been underweight on the banks for the last 3-4 years, but having said that, I think last Tuesday's event seems to have taken the situation as though only banks will bear the entire brunt. That's not true, because if you're going to have higher interest rates in the economy, I think other sectors are going to suffer far more than banks, because banks are going to get some pricing power if they choose to exercise it. So I don't know why the market has reacted in such a way as though banks are the only people who are going to get hurt. No one else will get hurt. So my reading is, if they were to implement what was agreed last Tuesday in the form of much higher short-term interest rates, I think we're going to see a far bigger impact on the economy. But at the same time, I think the problems of rupee continuously depreciating may come off. That would be the flip side of it. But I don't think the market is believing in, because if you see what's happening, tech is actually doing well, pharma is doing well, and banks are doing badly.
So Naren, are you using the current carnage in financials to your advantage to buy into good quality banks, maybe some NBFC stocks, maybe good quality private banks which have been beaten black and blue only because of sentiment, not because of earning concerns?
Yeah, actually, since we are underweight, we are looking at the point to bottom fish at this point of time. But at the same time, you know, you don't know, given the fact that, you know, it's still a very large component of the index, and the holdings of financials by FIIs are at record. You don't know what whether you should do it at one go or do it over a period of time. We believe we should do it over a period of time, given the huge ownership of financials. But the basic point that we are not able to understand at this point of time is, why is the market only focused on financials for this entire carnage, when in our opinion the outlook for growth in the near term is certainly much dimmer than what we have seen.
Naren, let's stay with FMCG. You know, several institutional investors are of the view that FMCG stocks are expensive, at least the large cap FMCG stocks, and I know your thoughts that you even find those stocks expensive. But what explains so much of price action and momentum in names like HUL, ITC, Nestle? These are not retail dominated stocks, these are institutional dominated stocks. So which are some of these institutional investors who are buying into these large cap stocks?
Actually, you should ask those institutional investors, because in our view, we have taken a position quite some time back that we believe these sectors are overvalued. And today I'm getting stocks, for example, in the PSU space, absolutely cash-rich companies trading at 6% dividend yield and 5-6 fees. So why should I go for 35 to 40 PE trailing PE stocks with the same 2-3% dividend yield when I'm getting much cheaper stocks in the market at this point of time? But somewhere this trend is caught on, and I don't think you would ask the buyers, because my experience in 2007 suggested that if you buy very overvalued stocks, sometimes you go through many years of underperformance, as we have seen already in the capital goods and power utilities pack. So my view has been that we have to be cautious in these sectors, because I don't think you can make big absolute returns in 40 PE stocks with $50 billion market cap kind of companies or $30 billion market cap kind of companies. So I don't know whether that is likely, but the fact is the trend in the last 1 year has been like that.
What's the call on IT then, Naren? I mean, Infy is surprised on the upside. TCS, no surprises there, has always been a stupendous performer. Do you think there is more upside in the sector right now? And would it make sense for anyone to get into the sector now for a buy?
So actually, one of the analysts had done a piece. Currently, the IT pack trades at 50% discount to FMCG pack on price to earnings. The normal, it seems, is around 25 to 30%. So almost IT on a valuation basis is far cheaper than consumers at this point of time. So we've been obviously much more constructive on IT than we have been on consumers, because we find that sector has valuations. In fact, most of the mid caps in the sector actually trade at single digit valuations, so giving us opportunities. So we've been positive on the sector. You know, today if you look at it, some of the leaders there are talking about growth rates of more than 14-15%. We are not able to meet a domestic sector today, which can generate a growth of even 7-8% this year. So in that situation, obviously, even whether a value investor or growth investor, both are being led into tech at this point of time.
Well, Reliance is down, TCS is not contributing, and Nifty is not falling. Well, that's largely because of IndusInd Bank, Maruti, Bajaj Auto and Coal India. Coal India could be bouncing back, but Bajaj Auto was a big mover on Friday. Maruti numbers are due today. Naren, because monsoons are better this year, is there a case to buy into two-wheelers now? Good monsoon means good crops means rural income will go up. If rural income will go up, discretionary spend will pick up.
Yeah, actually there should be some, but if you see some of the stocks in the sector, they've actually done 20%. If you go back 1 year back and ask people what would be the growth rate people were expecting were far higher than what happened. But still the stocks have delivered 20%. So the point is that do we believe that the valuation is reasonable? Yes, it is reasonable. But is it undervalued? I don't think it is undervalued.
So apart from metals or PSU banks, what is undervalued? What is cheap in this market?
Actually, if you think about it, the entire small and mid caps is dirt cheap today. Exclude about 10-15 stocks in the market. I think the rest of the market is trading at 2006 kind of valuation. So I think clearly there is a huge possibility of, in fact, one of the brokers was saying that if you exclude a few sectors like consumer staple, technology and pharma, today we are at an index level of about 4,500 or so. And if you exclude private sector banks, it seems you reach 4,100 index level at this point of time. So I think the bulk of the market is very cheap. The fact is that we have to get over this entire current account deficit problem. And we have to also have a growth outlook. You know, the problem at this point of time is whichever corporate we meet tells us we don't want to do any investment. We're just basically running our existing facilities, but we're not keen on investment. I think we need investment, we need jobs, we need exports. So I think that trend is where I think the government has a big task ahead to actually convince the corporate sector to move very substantially on both investment, exports, and actually start hiring.
Naren, so what's the expectation when it comes to the cap goods space? I mean, today we've got L&T slated to come out with its earnings, but as we approach closer to election, do you think construction and infra spend is going to get any sort of boost, and will these names then actually benefit?
See, the 3-year view looks very good because you can't have 7-8 years of no infrastructure growth. But the 1-year view, when we look and try to do bottom-up work and talk to companies, I think then 1-year view on the investment cycle has been very, very bad. It's been bad even 3 months back. It's bad now. Despite the good monsoon. So I don't think we're going to see an infrastructure cycle revival in the current year. But having said that, if I take a 3 to 5 year view, you can't but have a revival, because you can't have a situation just after 2007 that for till 2015 you don't have any infrastructure revival. We thought about it like that 1 year back as well, but it's not yet translated. But I would still say that the long-term view on infrastructure has to be good. But the shorter term view has been bad right from 2009 onwards till date.
So Naren, at a time when economy hasn't bottomed out, the next growth cycle could be 2 or 3 quarters away. We don't know which way interest rates will move. Earnings are likely to be noisy. Margins haven't bottomed out. Revenue growth is not back. What should one buy?
See, I think we've been saying the same thing. One is that everyone believes equity market should be invested when everything is good. Actually, equity market as a asset class has to be invested when everything is bad. So from that point of view, equity markets are very attractive for long-term investment today. With the exception that FIs have hardly sold, I would say equity markets are extremely attractive for long-term investment because most of the indicators that you look for are looking negative. The second is, if I take thematically, if you ask me, there is no possibility that you need to have growth in exports. So as a thematic piece, we have always been recommending export as a thematic piece for the past 1 to 1.5 years. Even if you see some of the sectors in that piece, they've all done well. If you see technology, you see pharma, now you see, for example, sectors like textile, some of the auto names which are export oriented. These have all done well. And my reading is it's the easiest thematic piece at this point of time. Everyone knows where rupee is. Everyone knows we need to increase our exports. So I don't know why. I think clearly, if I think about it, equities, except those 10-12 stocks which look overvalued, I think are clearly asset classes to invest with a long-term view, and export as a thematic category look very, very interesting at this point of time.
Right, so final word on the market. I mean, is this still a pullback in an otherwise downtrending market, or do you think because we've crossed past the 6,000 mark on the trading range, there is case for some more upside in the near term?
So our view has been that markets are range bound, will be volatile till election. I think there are reasons for volatility in addition to the election through what the Fed does. So I think we believe we are in a range bound volatile market that remains. If the government actually creates a strategy whereby the short-term money market rates do go up significantly, I think the shorter-term outlook for equities goes down, but the long-term outlook, in that short-term outlook, when the short-term outlook is bad or if the market falls due to that, I think that becomes a much better long-term market. So I would say right now we are in a range-bound volatile market, and that's what we have had a belief for quite some time. If you are a genuine long-term investor, it's clearly a time to buy. But most of the genuine long-term investors in equities are now crying, so they have not been investing. But I think the time today is much better for long-term investing than it was in 2010, when we actually didn't think it was that cheap, the market was that cheap. Today, X 10-12 stocks, the market is genuinely cheap.
Fair point, Naren. Good having you on the show, and thanks as always for taking time out and joining us on the show today.